This video, I'm talking about 401k hardship withdrawals and what you need to know. If you're new here, be sure to hit the subscribe button, and the links to everything that we mentioned in this video you can find in the description box below. So let's jump right in. A record number of Americans are taking hardship withdrawals and tapping into their 401ks. According to Fidelity, participants taking hardship withdrawals from their accounts rose to 2.4% last year, up from 1.9% in 2021. This represents the highest share of hardship withdrawals recorded by the financial services firm. Vanguard also recorded a rise in hardship withdrawals in 2022. About 2.8% of participants in its plans made hardship distributions in 2022, up from 2.1% in 2021. While alarming, it isn't surprising, as last year saw record high inflation, rising interest rates, and a 15% year-over-year increase in credit card balances. While more 401k investors are tapping into their retirement accounts, Fidelity reports investors are taking out smaller amounts. The typical 401k hardship withdrawal in the first quarter of 2021 was $3,900. But that dropped to $2,200 in the fourth quarter of 2022. And whether 401k investors need the money to cover medical bills, to stay off eviction, or to pay tuition expenses, it's clear they're hurting for extra cash right now. So before you dip into your retirement savings, it's critical to understand the implications of doing so. From taxes to losing more money than you had planned, there's a lot more to consider before making the move. So keep watching for a breakdown of the 401k hardship withdrawals and alternatives to tapping into your 401k. First, let's define the hardship withdrawal. Hardship withdrawals are defined by the IRS as taking money out of your 401k because of an immediate financial need that's limited to the amount to satisfy the hardship need, not the amount you want. The need of the employee also covers the employee's spouse or dependents. And with a 401k hardship withdrawal, you'll pull money from your savings and you cannot pay it back like you do a 401k loan. Whether you qualify for a hardship withdrawal depends on certain circumstances deemed to be immediate and heavy, and limited to the amount necessary to satisfy that financial need defined by the IRS as a hardship. Now, these include certain medical expenses, costs relating to the purchase of a principal residence, excluding mortgage payments, tuition and related educational fees and expenses, payments necessary to prevent eviction from or foreclosure on a principal residence, burial or funeral expenses, and certain expenses for the repair or damage to the employee's principal residence that would qualify for the casualty deduction under IRC Section 165. If you qualify for a hardship withdrawal, the money you take out will be taxed as ordinary income if you're under age 59 and a half, but you won't have to pay the 10% penalty. So let's talk about key factors to consider before pulling your money from your 401k. Number one, first things first, not all plans allow for the hardship withdrawal. And if your plan does allow for it, you will likely have to provide proof of the hardship and get approval that it meets the criteria. Next, the money may not be immediately available. Each plan has its own set of rules that it must follow, so it may take weeks to get the money from your 401k. If you need cash ASAP, you need to look for other alternatives. Third, taxes are another thing to consider. And whether you qualify for a hardship withdrawal or not, you must pay taxes on the amount withdrawn, and it's considered ordinary income. The last thing you want to do is get cash for a short-term need, only to find out it's bumped you up to the next tax bracket. If you're willing to take the tax hit, we still recommend you speak with your CPA or tax professional to find out the real cost of cashing out. When all is said and done, the costs may outweigh the need. Fourth and last, and this is a big one, you should avoid taking out money from your 401k when the market's down. Remember, you only lose money if you cash out at the bottom of the market. taking a 401k withdrawal when the market is low means you have to withdraw a larger percentage of your account. If you're still watching, please hit the like button, make sure you subscribe to our channel, and hit the little bell on the right to receive notifications of our next posted content. Let's move on and talk about alternatives to a 401k hardship withdrawal. In an ideal world, you wouldn't touch your 401k until retirement. However, life happens, and sometimes you have to do what you have to do. We get it. Here are a few alternative options to the 401k hardship withdrawal should you need money to cover an emergency. Medical expenses. There are numerous companies that provide financing options such as Care Credit or ASUM, or for qualified medical expenses, you can use your HSA savings. Housing and living expenses. Tap into other non-retirement accounts such as brokerage accounts. Take money from your Roth IRA. Take out a home equity line of credit because you use your home as collateral and you may get a better interest rate and a longer term to pay it back. Take out an unsecured personal loan to help get you through. Or apply for a 0% credit card and put the money on that card and then pay off interest-free before the interest-free promotional period expires. Ask family or friends for a personal loan. If you go this route, don't just borrow the money, make it more formal so you can take the emotion out of it. Drop a contract with a payment schedule and then stick to it. Another option is to take out a 401k loan. With a 401k loan, you have to just borrow from yourself and you have to pay it back with interest, typically within 5 years of taking out the loan. A 401k loan is not a distribution like the hardship withdrawal. The benefit here is that you do not have to pay penalties and taxes should you pay it back on time. And the interest you pay on the loan goes back into your retirement savings. Now there's a downside. In the event you lose or quit your job, you will be forced to pay it back the loan in full before tax day the following year. And if you can't pay it back on time, the loan will be treated as an early withdrawal and the unpaid loan balance will be considered a taxable distribution. Also, if you're under age 59 and a half, you're going to have to pay a 10% federal tax penalty on the unpaid balance as long as the income taxes on the balance of the loan. So here's some final thoughts. Should you need money for a hardship, whatever you decide to do, we recommend that you speak with a tax professional as well as a financial advisor. That's it for today, everybody. If you found this content helpful, please share it with the people that you love, trust, and respect. Make sure you subscribe to our channel and check back with us soon for our next freshly posted content.